There is an institution in America that controls the interest rate on your mortgage, the return on your savings account, the cost of your car loan, the value of every dollar you have ever earned. And you have never once voted for anyone who runs it. You cannot fire them. You cannot override their decisions. You cannot even fully audit them. The Federal Reserve has more power over your daily financial life than Congress, the President, or any elected official in America. And most Americans cannot explain what it actually does. That is not an accident. Today, we fix that. Go back to the night of November 22nd, 1910. A private rail car departs from Hoboken, New Jersey, under cover of darkness. Its passengers are instructed to use first names only, no last names, so that no one overhearing the conversation can identify who is on board. They are told to arrive separately, at different times, so as not to be seen together at the station. Among the passengers, Senator Nelson Aldrich, the most powerful man in American banking legislation, Frank Vanderlip of National City Bank, Henry Davison of J.P. Morgan, Paul Warburg of the Kuhn Loeb Investment Bank. Their destination, Jekyll Island, Georgia, a private resort accessible only by boat. Their mission's secret. They spent 10 days on that island, and when they left, they had drafted the blueprint for the Federal Reserve System, the private rail car, the fake first names, the remote island, the secrecy. This was not a government meeting. This was a gathering of the most powerful private bankers in America, designing the institution that would control the nation's money supply. And they did not want anyone to know they were doing it. The Federal Reserve was created by Congress in 1913, sold to the American public as a solution to the financial panics, the Panic of 1873, the Panic of 1893, the Panic of 1907. Each one had wiped out banks, businesses, and ordinary American savings. The pitch for the Federal Reserve was simple and appealing. A central bank would stabilize the system. It would be a lender of last resort. Americans tired of financial instability largely accepted this argument. What they were not told was how the institution would actually be structured. The Federal Reserve is not a government agency. Its board of governors is appointed by the president. That part is public. But the 12 regional Federal Reserve banks are privately owned by member banks, the very institutions the Fed is supposed to oversee and regulate. The Fed funds itself, not from taxes, but from interest on government bonds and fees. It charges the banking system. It does not require congressional approval for its major decisions. It operates in its own language, with independence, which means the institution that controls the price of money in the world's largest economy answers, ultimately, to no voter. So what has the Federal Reserve actually done with this power? Let's look at the record. In 2008, when the financial system collapsed, the Fed's response was not to let the market correct itself. It cut interest rates to near zero. It created a program called quantitative easing, where the Fed created new money to buy government bonds. At its peak, the Fed's balance sheet expanded to nearly $9 trillion. $9 trillion of assets, bought with money, created from nothing. Asset prices soared. Stocks, real estate, and financial instruments all surged in value because cheap money was flooding into markets looking for returns. For Americans who owned significant assets, their net worth exploded. For those who owned little, wages barely moved while the cost of living climbed. The wealth gap, already wide before 2008, became dramatically wider, and the Fed kept rates near zero for over a decade. Then came 2022. Inflation, fueled by pandemic supply chain disruptions and years of money printing, surged to its highest level in 40 years. And the Fed's response was to raise interest rates aggressively, from near zero to over 5% in roughly 18 months. The intention was to slow inflation. The effect on ordinary Americans was immediate and brutal. Mortgage rates doubled, then nearly tripled. Millions of Americans who might have bought homes were priced out of the market permanently. Small businesses saw their costs explode. Regional banks that had loaded up on long-term bonds at low rates suddenly had balance sheets that didn't add up, and several collapsed overnight. Meanwhile, the large banks that had benefited most from a decade of near-zero rates sailed through the transition with relative ease. Here is the question that every American should be asking. If the Federal Reserve is independent, Who is it actually independent for? Its leaders rotate in and out of the major investment banks. It is supposed to oversee. Its policies prioritize financial markets over workers. When markets crash, the Fed acts within days. When wages stagnate, the Fed treats it as a feature, not a bug. The language of central banking, technical, wrapped in academic jargon, designed to be opaque, serves one purpose: to make the most consequential financial decisions feel too complicated for ordinary people to have an opinion about. Understanding the Federal Reserve does not make you a conspiracy theorist. It makes you financially literate. It means you understand that the interest rate on your mortgage is set by 12 unelected people in a room. Subscribe to Finance Origins. Because financial literacy is not just about budgeting, it is about understanding the system you live inside. Follow the money.